We just talked about what happened on the parent book when the parent has less than 100% ownership of the subsidiary. Now let's look at the consolidation worksheet. On the consolidation worksheet, the consolidation in the presence of non-controlling interest, it is essentially almost the same, very similar to what we did before. But there are also some small differences. So first of all, worksheet entries SIIDE, those are kind of entries I prepared. And then if it is in the subsequent year, we need star C entry. And one of the major difference is a column is added to the worksheet to record non-controlling interest in the sub. So we are going to add, after all of the consolidation entries, we are going to add a column which records the change in the non-controlling interest. And also we need to kind of separate controlling and non-controlling interest in some of the places in the worksheet. So let's specifically look at the consolidation entries. As the purpose is to eliminate subsidiaries beginning stockholders equity account. But here is something new. We need to also allocate it to between the controlling and non-controlling interest. And consolidation entry A, now we are separate consolidation entry A into consolidation entry A1 and consolidation entry A2. A1 is to increase subsidiaries book value to fair value, adjusted for amortization and allocated to controlling and non-controlling interest. So this part is kind of new as well. A2 is to recognize goodwill. So now you see that A1 and A2, it used to be that in A, we just take care of both the markup of the subsidiaries book value to fair value and to recognize goodwill in one consolidation entry. But now when we have non-controlling interest, we're separated into A1 and A2. A1 is to take care of the difference between book and fair value. And A2 is to recognize, specifically for recognizing goodwill, and also allocated to controlling and non-controlling interest. So why do we need to separate those two? The reason is when we allocate the difference between controlling and non-controlling interest, A1, we just do it according to the percentage of ownership. But A2, actually, sometimes we can do it according to the percentage of ownership, sometimes not. So the way we calculate it, I'm going to teach you a way that we don't need to worry about when or when not. It will end up that some of the calculation will end up exactly, it's just like you're allocating it according to the percentage of ownership. But in some of the situations, it won't. Actually, it depends on whether the parent is, whether there's any premium paid there in acquiring, in order to obtain a controlling interest. So we're going to talk more about this part later. Consolidation entry I, remove subsidiaries income recognized by the parent during the year. So here is exactly the same as before. Consolidation entry D, remove dividend recognized by the controlling interest during the year. So here we only need to worry about the controlling interest dividend. Consolidation entry E, record excess amortization or depreciation, amortization expense. So here is the same as before. And this is the column we're adding here about non-controlling interest. So the formula here is non-controlling interest at the end of the year equals to the non-controlling interest at the beginning of the year, plus the current year non-controlling interest in subs current year net income, minus non-controlling interest share of the subs current year dividend. So this is easy to understand, right? Non-controlling interest at the end equals to the beginning non-controlling interest plus the current year non-controlling interest share of the subsidiary's income minus the current year non-controlling interest share of the subsidiary's dividend. So non-controlling interest share in subsidiary's income, it is also called net income attribute to non-controlling interest. And the formula for calculating this is subsidiary's net income minus excess amortization. So minus the current year amortization multiplied by non-controlling interest percentage of ownership. So this is the formula. And let's continue the previous example so that we can have a concrete idea of how to do consolidation when there's non-controlling interest. So let's continue this example. We just calculate in the presence of non-controlling interest what happened on the parent book. And now let's take the parent book and put it here as the first column of your consolidation worksheet. And then let's also take the subsidiaries financial statement here. So the consolidation, this is subsequent to the year of acquisition. And this is when the parent is using the equity method. So there's no need for consolidation entry start C and here. We start from consolidation entry S. In consolidation entry S, consolidation entry S is to eliminate subsidiaries shareholders equity account. So subsidiary has common stock 230,000. To eliminate it, we debit 230,000. Its beginning return earning is 580,000. To eliminate it, we debit 580,000. So what is the total? The total is 810,000. And this total number, it is divided between controlling interest and non-controlling interest. Non-controlling interest has 20% of it. So 20% of this is 162,000. And controlling interest has 80% of it. 80% of this is 648,000. So we decrease the investment account by 648,000. And 162,000 goes into non-controlling interest. So this is consolidation entry S. Consolidation entry A1, the purpose is mark up subsidiaries book value to fair value, and we allocate it between controlling interest and non-controlling interest according to the percentage of ownership. So the difference here we have trademark, which is not amortized. The trademark has an initial difference of 60,000 and it is not amortized. So we mark it up by 60,000. Patented technology has an initial difference of 120,000. It is amortized. It has been amortized for how many years? For 1 year. So each year the amortization is 6,000. So the ending balance is 114,000. That is the initial difference. After 1 year's amortized, so we're standing at this is 2015 consolidation, and then consolidation entry A, that is to mark up for the beginning. So this is we're doing the current year amortization here in consolidation entry E. So A is only after 1 year's amortization. Equipment, the initial difference is negative 10,000, and it is after 1 year's amortization. So now the difference is negative 9,000. Long-term liabilities, the initial difference is 40,000. After 1 year's amortization, now the difference is 35,000. So 60 plus 114 minus 9 plus 35,000. And then this is the total markup is 200,000. It is divided between controlling and non-controlling interest. So controlling interest gets 80% of it, which is 160,000. Non-controlling interest gets 20% of it, which is 40,000. So we decrease the investment account by 160,000. And then the other 40,000 goes into non-controlling interest. This is consolidation entry A1. Consolidation entry A2 is to record goodwill. So goodwill is 25,000. 80% of 25,000 is 20,000. So we decrease the investment account by 20,000. And another 20%, which is 5,000, goes into non-controlling interest. Consolidation entry I, the purpose is to eliminate the subsidiary's income recognized by the parent, so which is 64,000. And then we decrease the investment account by 64,000. Consolidation entry D, the purpose is to eliminate the parent's share of subsidiaries' dividend. So the dividend paid by the subsidiary is 50,000. And parent has 80% of it. So here we, So here we eliminate 80% of 50,000, which is 40,000. And we increase the investment account by 40,000. Consolidation entry E, the purpose is to recognize the current year amortization and depreciation. So the current year amortization for the patented technology is 6,000. The depreciation, that is 6,000. The depreciation, the safety depreciation equipment is 1,000. And for long-term liabilities is 5,000. So patented technology is an intangible, that is amortization expense. Equipment is a tangible, so that is depreciation expense. So that is depreciation expense. And then long-term liability, that is a liability. So that is actually viewed as interest expense. So those are the three assets and liability that has a difference in fair and book value. And then the last column here, this is what is a new column here. And one thing to pay attention here is all of the consolidation entries. So this part, those are journal entries. And this non-controlling interest, this is not a journal entry. So this is an important part because all of the previous ones are journal entries. So all of the debit should be equal to the sum of the credit. So if you sum up each of those columns, that will give you a number of 0. But however, this column, non-controlling interest, this is just for calculation. This is just for calculation purpose. It's very similar to the consolidated total. This is not a journal entry. So for this column, you don't need to sum up it to 0. What do we do for this column? We first start from calculate the non-controlling interest beginning balance. So non-controlling interest beginning balance is basically the sum of those numbers. That will give you 207,000. So this is step 1. The first number you need to calculate for this column. And then you need to know how much of the current year net income belongs to the non-controlling interest. So net income attribute to non-controlling interest. How to calculate this number? So the formula was already given just now. Let me write it. Let me just write it here. So we know the current year subsidiaries net income is 90,000. And then we take out the current year amortization 10,000. And then multiply by the non-controlling interest share of the subsidiaries, the non-controlling interest ownership of the subsidiary, which is 20%. So this will give you 16,000. And this is the net income which belongs to the non-controlling interest. So this is the second number you need to calculate here. And the third number you need to calculate in this column is how much dividend is paid out to non-controlling interest. So that is basically 50,000, the total dividend paid multiplied by 20%. So that is 10,000. This is the third number here. So one thing to pay attention here is for this dividend paid, because we either, so here we can either consider the column or we consider the row. We cannot consider both. And here we choose to consider the column, meaning that because this column, it is not a journal entry. So we're using, we put parentheses here for this 207,000 because we view it as the beginning non-controlling interest. And so net income should be consistent with the beginning non-controlling interest. And dividend paid should be opposite to beginning the beginning non-controlling interest. So that's why we don't put parentheses here for this 10,000. So that may be something may cause confusion to you, but you just need to remember for this 10,000, we don't need to put it into parentheses, even though it is a dividend paid. And then to the last step is to calculate non-controlling interest at the end of the year. So for D, when just, sorry, for D, we basically just add up A and B and C. So if we add up these three numbers, that will give you the end of the year non-controlling interest, which is 213,000. So this is this column, this new column. And then for consolidated total numbers, we do something very similar as before. We add up everything, almost everything horizontally. Revenue adds up to 1,340,000. Cost of goods sold is 544,000. Depreciation expense is 79,000. Amortization expense is 181,000. And interest expense is 120,000. So the same as before, equity in subsidiary earnings should go to 0. And if you add up all of this, this will give you consolidated net income of 416,000. And this consolidated net income, oh, sorry, this goes. And this consolidated net income is divided between controlling and non-controlling interest. So let me erase this part. For the controlling interest, for the non-controlling interest, we already calculated 16,000. So the non-controlling interest would get 400,000. And this 400,000, this is carried over to a statement of retained earning. On your statement of retained earning, the beginning retained earning is 860,000. And dividend declared is 60,000. So why is it 60,000 here? So as I have explained, there are two ways to look at this. So here, even though we are writing 10,000 here, you should view it as taking out 10,000 because this is not a journal entry. So even though we write 10,000 here, when we are calculating it horizontally, you need to view it as not add 10,000, but take out 10,000. And there's another way to view this. So the other way to view this is the parent's dividend plus the subsidiary's dividend plus the intra-equity part. All of this adds up to how much? 70,000. And this is divided between controlling and non-controlling interest, because controlling interest get 10,000, so non-controlling interest get 60,000. So those are the two ways to view this. So here, this 10,000 not writing in parentheses may cause some confusion, but if you get used to it, you will just understand it. You just cannot write it to fit both the column and the row here. So either if you write it in parentheses, it will fit your calculation for the row, but then it won't fit your calculation for the column. So here we just choose to write it not in parentheses so that it can fit the calculation for your column, for your non-controlling interest part. And then we have to adjust it when we have to view it a little bit differently when we are calculating the row, in the sense that we do not add 10,000, we need to take out 10,000 here. So this is dividend declared, and on the statement of return earning, we add up everything, and that will give you 1.2 million ending return earning. And we carry out this number to our balance sheet. So this 1.2 million ending return earning, that is for the parent's ending return earning. And then non-controlling interest, we're going to talk about it later. Let's first look at the assets. The asset side, current asset add up to 1,171,000. Your investment account should be eliminated. Oh. Trademark adds up to 659,000. Patented technology is 1,528,000. Equipment is 542,000. Goodwill is 25,000. So if you add up everything on the asset side, that will give you 3,925,000. So this is on the asset side. And at the liability side, your total long-term liabilities is 1,642,000. Common stock adds up to 870,000. And then your total non-controlling interest, it is already calculated here, that's 213,000. So as you can see here, your total non-controlling interest, it includes everything. It just includes everything regarding non-controlling interest is summed up here in this column, which means that your common stock, it is just the parent's common stock. Your return earnings here is just the parent's return earning. They are already, they don't include anything regarding non-controlling interest. So all of non-controlling interest share of the capital is summed up in this one account. And then if you sum up the total liability and shareholders' equity, that will give you 3,925,000. So your last check here is your total assets should be equal to your total liability and shareholders' equity. So this is what is happening on the consolidation worksheet.